1. Understanding real estate investment options. Tom bien puedes leer how to invest in real estate with little money, smart strategies. Before diving into the specifics of how to invest with $1,000, it's essential to understand the different ways you can invest in real estate. Here are some common options. A. Direct ownership single-family homes, purchasing a single-family home to rent out or flip. Multifamily homes, investing in duplexes, triplexes, or apartment buildings. Commercial real estate, investing in office buildings, retail spaces, or industrial properties. B. Indirect ownership. Real estate investment trusts, REITs, companies that own, operate, or finance income-producing real estate. Real estate crowdfunding, pooling money with other investors to invest in larger real estate projects. Real estate ETFs and mutual funds, investing in funds that hold a diversified portfolio of real estate assets. C. Alternative real estate investments. Real estate notes, investing in mortgage notes or other debt instruments tied to real estate. Real estate partnerships, joining forces with other investors to pool resources and share profits. 2. Investing in real estate with $1,000, strategies. También puedes leer advantages and disadvantages of investing in real estate. Key insights in 2025. With $1,000, direct ownership of property is generally out of reach. However, there are several indirect and alternative methods to invest in real estate with this amount. A. Real estate investment trusts, REITs. What are REITs? REITs are companies that own, operate, or finance income-producing real estate. They allow individual investors to buy shares in commercial real estate portfolios. How to invest? You can purchase shares of publicly traded REITs through a brokerage account. Many REITs have low share prices, making them accessible to investors with limited capital. Pros: liquidity, diversification, and passive income through dividends. Cons: limited control over the properties, and REITs can be sensitive to interest rate changes. B. Real estate crowdfunding. What is crowdfunding? Real estate crowdfunding platforms allow multiple investors to pool their money to invest in larger real estate projects, such as apartment complexes, commercial properties, or development projects. How to invest? Platforms like Fundrise, Realty Mogul, and CrowdStreet allow you to invest with as little as $500-$1,000. You can choose specific projects or invest in diversified portfolios. Pros: access to larger projects, potential for higher returns, and diversification. Cons: illiquidity, your money may be tied up for several years, platform fees, and higher risk compared to REITs. C. Real estate ETFs and mutual funds. What are real estate ETFs/mutual funds? These are funds that invest in a diversified portfolio of real estate assets, including REITs, real estate companies, and physical properties. How to invest? You can buy shares of real estate ETFs or mutual funds through a brokerage account. Examples include Vanguard Real Estate ETF, VNQ, and Schwab US REIT ETF, SCHH. Pros: diversification, liquidity, and lower risk compared to individual REITs or crowdfunding. Cons: lower potential returns compared to direct real estate investments, and management fees. D. Real estate notes. What are real estate notes? Real estate notes are debt instruments secured by real estate. When you invest in a real estate note, you're essentially lending money to a borrower who has used real estate as collateral. How to invest? Platforms like PeerStreet and Lending Home allow you to invest in real estate notes with as little as $1,000. You earn interest on the loan, and if the borrower defaults, you may have a claim on the property. Pros: regular income through interest payments, and lower risk compared to direct property ownership. Cons: risk of borrower default, and your investment is tied up until the loan is repaid. E. Real estate partnerships. What are real estate partnerships? In a real estate partnership, you pool your money with other investors to purchase properties. Each partner contributes capital and shares in the profits, or losses, of the investment. How to invest: you can join a real estate investment group or form a partnership with friends or family. Some crowdfunding platforms also offer partnership opportunities. Pros: access to larger properties, shared risk, and potential for higher returns. Cons: requires trust and clear agreements among partners, and potential for conflicts. 3. Key considerations when investing in real estate with $1,000. A. Risk tolerance: real estate investments can be risky, especially with a small amount of capital. Understand your risk tolerance and choose investments that align with your comfort level. B. Investment horizon. Some real estate investments, like crowdfunding or partnerships, may require your money to be tied up for several years. Ensure you're comfortable with the investment horizon before committing. C. Fees and expenses. Be aware of any fees associated with your investment, such as platform fees, management fees, or transaction costs. These can eat into your returns, especially with a small investment. D. Diversification. Even with $1,000, it's important to diversify your investments. Consider spreading your capital across different types of real estate investments to reduce risk. E. Research and due diligence. Thoroughly research any investment opportunity. Understand the market, the property, and the platform or company you're investing through. Look for reviews, ratings, and any red flags. 4. Steps to get started. A. Set clear goals. Determine what you want to achieve with your real estate investment. Are you looking for passive income, long-term appreciation, or diversification? B. Choose the right platform. Select a platform or method that aligns with your goals, risk tolerance, and investment horizon. Compare fees, minimum investment requirements, and track records. C. Open a brokerage account, if necessary. If you're investing in REITs, ETFs, or mutual funds, you'll need a brokerage account. Choose a reputable broker with low fees and a user-friendly platform. D. Start small and scale up. Begin with a small investment to get a feel for the platform or method. As you gain confidence and experience, you can gradually increase your investment. E. Monitor your investment regularly. Review your investment's performance. Stay informed about market trends and be prepared to adjust your strategy if necessary. 5. Potential returns and risks. A. Potential returns. REITs. Historically, REITs have offered average annual returns of around 8 to 12%, including dividends. Crowdfunding. Returns can vary widely, but some platforms offer projected returns of 8 to 15% annually. Real estate notes. Interest rates on real estate notes typically range from 6 to 12%, depending on the risk level. ETFs/mutual funds. Returns are generally lower, around 5 to 10% annually, but with lower risk. B. Risks. Market risk. Real estate markets can be volatile, and property values can decline. Liquidity risk. Some investments, like crowdfunding or partnerships, may lock up your capital for several years. Default risk. Borrowers may default on loans, especially in economic downturns. Platform risk. The platform or company you invest through may fail or mismanage your investment. 6. Conclusion. Investing in real estate with $1,000 is not only possible but can also be a smart way to diversify your portfolio and generate passive income. By leveraging platforms like REITs, crowdfunding, and real estate notes, you can gain exposure to the real estate market without needing significant capital. However, it's crucial to understand the risks, conduct thorough research, and choose investments that align with your financial goals and risk tolerance. Remember, real estate investing is a long-term game. Start small, stay informed, and be patient. Over time, your $1,000 investment could grow into a substantial asset, providing you with financial stability and potentially significant returns.